I didn't see yesterday's numbers, but I know last Wednesday and Thursday there was another 5 or 6 million of silver onshored, and that was after the tariff date. So, there's no way they would ship it. They would ship it late so that it got here after the tariff. So it tells me that the metal basically has been coming here to be delivered. And I think any additional metal over and above that is just reshoring the metal. I mean, metal has been leased for years and years, and I think some of the entities that lease metal are saying, we want our metal back.
Gold reached a new all-time high on Thursday as the U.S. dollar weakened and investors shifted their focus to safe haven assets amid escalating tensions in the trade dispute between the U.S. and China. Gold futures jumped by as much as 3%, hitting an intraday peak of $3,193 per ounce, before pulling back slightly as traders took in the latest updates on President Trump's evolving tariff policy. The White House clarified that the recently hiked tariffs on Chinese imports are now set at 145% higher than the previously assumed 125%. This came after Trump announced on Wednesday a temporary pause on reciprocal tariffs for most U.S. trade partners, while doubling down on higher duties against China. Michael Brown, a senior strategist at Pepperstone, commented on the unpredictable nature of these policy shifts, saying the ongoing lack of coherence in trade actions could further support the bullish narrative for gold. So far this year, gold futures have climbed over 20%, hitting record levels repeatedly as trade-related uncertainty grows and market participants increasingly anticipate rate cuts from the Federal Reserve.
The great taking is something that a lot of people don't know about. A lot of people can't believe it. And when you tell people about it, a lot of them want to stick their head in the sand and not believe it. But these laws have been put on the books beginning in 2014 all over the world. The ink is dry everywhere. So these are hard and fast laws that are on the books. And the short of it is, anytime you deposit money with a bank or stocks or have stocks or bonds with a broker, those are not your monies. They're not your stocks, not your bonds legally. They're owned by the bank or they're owned by the broker for your benefit. But the way the law reads is if they get into trouble financially, they can take your assets because they're on their balance sheet. They can take your assets and save themselves. And you have no legal recourse back to getting your assets back. So just understand when they do collapse the system, and I mean, the system is going to collapse, whether they pull the plug on purpose or try to keep it up as long as they can, mathematically, this thing's going to come down. And when it does, you're going to lose your assets. And that's obviously the biggest benefit to owning gold or silver and having it in your hand. Or even in a storage facility, because in a storage facility, there's not a computer button that they can push and take your metal. It's actually got to be, physically moved or taken. But gold or silver, neither of them can bankrupt. And when the system bankrupts and people lose their assets, gold and silver will be the last two men standing. And if they're in your hand, you have wealth. The volatility, just the last 3 or 4 days, you've seen, NASDAQ's now already in a bear market. How often do you see markets down 10, 12% in 2 days? So the volatility that we've seen in what you're calling the first 100 days has really picked up over the last week. And the danger to the volatility is that you throw participants offside and into margin calls. And if you do that on a grand enough scale, if it's big enough and far-reaching enough, you're going to hit somebody who's big that can't pay. And that will start off a daisy chain of derivative failures. There's over $2 quadrillion worth of derivatives outstanding, completely dwarfs the financial system, completely dwarfs all treasuries and all sovereign central banks on the planet. So the danger is that you get a derivatives player that becomes insolvent, and then it will spread like a wildfire from there. As far as advice, I mean, I view the financial system as a complete Ponzi scheme that's going to be taken down. Where, like I just talked about the derivative failures, but also the assets themselves are going to get wiped out in value. It's time to get out of the pool. That's, I guess, the best way to say it is, or get off the railroad tracks. And the best way to do that and hold capital, again, is through gold and silver, because they cannot bankrupt. And the system itself is bankrupting.
Meanwhile, silver is struggling to recover after experiencing its steepest weekly drop since 2020, falling more than 13%. The plunge was fueled by growing concerns about a potential recession, forced selling, and weakening industrial demand. Much of the pressure on silver is tied to U.S. trade policy, particularly President Trump's broad tariff increases and specific restrictions targeting semiconductor imports. These moves have prompted a reevaluation of global manufacturing outlooks, especially considering silver's heavy use in industrial applications. China's retaliation, a 34% tariff on all U.S. goods, has further deepened fears of a prolonged trade standoff. Expectations for demand in major silver-consuming regions like Asia and Europe have dropped sharply. On top of that, a dramatic decline in the stock market, underscored by a 2,000-point plunge in Dow futures, triggered widespread margin call selling. Silver was hit especially hard as investors liquidated holdings to meet obligations elsewhere. Unlike gold, which held up relatively better due to its safe haven appeal, silver lacks strong monetary demand and support from central banks, leading to a more intense and lasting sell-off. Adding to the pressure was a stronger U.S. dollar and rising real interest rates. Treasury yields pushed higher following solid employment data, with the 10-year yield nearing 3.88%. As a result, the dollar gained ground and traders started to scale back their expectations for aggressive rate cuts by the Fed. Market attention now shifts to the Federal Reserve's minutes and the upcoming CP. I report both key events that could influence monetary policy direction. Should the Fed signal reluctance to ease, or if inflation data comes in hotter than expected, silver could face renewed pressure from tightening financial conditions and a stronger dollar.
70% or more, if you're just starting out, you want 70% or more in silver versus gold, and then at a later date, as silver outperforms and the ratio comes down, then you look to start swapping silver into gold, and you'll end up with more gold ounces. When the ratio comes down to 50, 40, 30, as silver outperforms, you're buying cheaper gold with more expensive silver. So you end up with more ounces. As for the U.S. Mint lineage, the reasoning behind that is, for instance, I mean, if you buy a gold eagle today or you buy a silver eagle today, the mint is basically selling it to you through a broker conduit. It'd be really difficult for them to sell eagles to you today and then next week and say, oh, by the way, we're confiscating it, you have to sell it back. Now, could they do that with Maple Leafs or Krugerrands or bars or whatever? Yeah, they could do anything they want. And they could do something with U.S. Mint lineage coin, but there will be lawsuits and there will be lag time where there would not be with foreign sovereigns or bars or generics. With silver, I believe it's hands down that you want to own junk silver. It's the smallest form, 14 dimes, roughly 14 dimes equals 1 ounce. So that's going to give you 14 barter transactions in a system down scenario versus one, whether it be a bar or a round or a foreign sovereign or even an eagle. So you want the smallest denomination. They are U.S. Mint lineage. They're readily recognizable. They really can't be counterfeited because junk can't be shiny. Junk needs to look like crap. It needs to look like it's been used because it was used. And when I said readily recognizable, as long as the coin says on it 1964 or earlier, you know it's a 90% silver content. So for silver, I think hands down, you want to do junk. Switching to gold, uh, again, you want U.S. mint lineage coin. It's much more likely that gold would be confiscated than silver. And just to mention on potential confiscation, it's my opinion they won't go after individual holdings. It's far more likely, in my opinion, that they would nationalize mining operations. They'd get more gold faster doing that, and going door to door, there's going to be deaths on day one. But as far as gold, you want either eagles or buffaloes, or 333 gold, which are the Liberties and St. Gaudens. They're as cheap as I've ever seen them in relation to spot. I mean, you can buy, I don't know, an MS 62, 63 Lib or Saint for basically the same price as an eagle, or maybe even slightly less. So the pre-33 gold, which, a lot of people shunned in past years because they had a 20 or 30% premium over spot. There virtually is no premium over spot. Now's the time to buy those.
As gold breaks new ground just as tariffs rise again, many analysts like Bill Holter, who has long warned about the combined risks of overwhelming debt, geopolitical friction, and a growing flight to tangible assets, are seeing their predictions unfold. What's your perspective? Is this the start of a major move in gold or a warning sign of broader financial instability? Drop your thoughts and predictions in the comments. And don't miss the next video, it lines up perfectly with this topic. Catch you there.